Gloria Hennessy is 71 years old. She lives in British Columbia. She spent 28 years as a school administrator, showing up early, staying late, filing everything correctly. When she retired, she had done everything the financial magazines told her to do. She had an RRSP. She had a TFSA. She had CPP coming in. She had OAS starting at 65. On paper, Gloria had a plan. What nobody told Gloria, not her bank, not her employer, not Service Canada, is that the way she was holding those accounts was quietly building a tax problem that would hit her hard the moment she turned 71. Not because she broke any rule, because one specific CRA rule she had never been personally told about was already working against her. And the consequence showed up not as a warning letter, but as a tax bill she was not expecting and a benefit reduction she could not reverse. Nobody warned Gloria. Not the CRA, not her bank, not her employer. And Gloria is not alone. Before I show you exactly what caught Gloria off guard and what you can do right now to make sure it never happens to you, one thing. CRA rules like this change without warning, and they do not personally notify you when the math shifts against you. Subscribe and hit the bell right now. Now let me show you what happened to Gloria. Tell me in the comments right now, did you know that how you hold your retirement accounts can trigger an OAS clawback or push you into a higher tax bracket in retirement? Yes or no? Drop your province below, because what this community shares shapes exactly what we cover next. Here is what Gloria did not know, and here is what is sitting inside the accounts of thousands of Canadian retirees right now, quietly building a tax problem that gets worse every year they wait. The 7 accounts we are going to talk about today are not unusual. They are accounts that millions of Canadians have. RRSP, RRIF, non-registered investment accounts, corporate holding accounts, old savings bonds, unused cash accounts earning interest, and the one that surprises people the most, a TFSA that was set up correctly but is being used in the wrong order. The problem is not owning these accounts. The problem is what happens when you hold too much and the wrong ones too long, and what the CRA does to your taxable income when the mandatory withdrawal clock starts running. Here's the rule in plain language. An RRSP must be converted to a registered retirement income fund, an annuity, or withdrawn by the end of the year you turn age 71. That is not a suggestion. That is a CRA deadline. And what happens the moment your RRSP converts to an RRIF is that the CRA requires you to withdraw a minimum amount every single year, whether you need the money or not. That minimum withdrawal is fully taxable as income in the year you take it. And if your RRSP or RRIF balance is large, because you did not draw it down strategically before 71, those forced withdrawals can push your total income above the OAS clawback threshold. If your income exceeds approximately $90,000 in retirement, some or all of your OAS may be clawed back. That is not a tax you pay once. That is a reduction that comes out of your OAS check every month, permanently recalculated each year based on what you reported to the CRA. The RRSP meltdown strategy involves drawing down your RRSP early to avoid higher taxes later. The best candidates are retirees with $400,000 or more in RRSP savings who retire before 65. Typical lifetime tax savings for large RRSPs using this strategy range from $80,000 to $150,000. Medio tiempo. That number, $80,000 to $150,000, is not money the CRA is stealing from you. It is money you leave on the table by not knowing the withdrawal order matters. The CRA published these rules in the Income Tax Act and in their official RRIF minimum withdrawal tables available on canada.ca. But they did not send Gloria a letter explaining that her withdrawal strategy was building a problem. They never do. This is exactly what happened to Gloria. She held her RRSP intact through her 60s, contributing the maximum, letting it grow, never touching it. When she turned 71, her RRSP converted to an RRIF automatically. The mandatory minimum withdrawals that followed added to her CPP and OAS income. Her total reportable income crossed the clawback threshold. Her OAS was reduced, and the TFSA she had, which could have sheltered that income, was not large enough to offset what was now flowing out of the RRIF as taxable income every year. If you take out too much from your RRSP, then you may jump to the next higher tax bracket and have your government benefits clawed back significantly. Gloria did not take out too much at once, but the mandatory RRIF withdrawals did the same thing gradually, year after year. YouTube. Canadians who work with retirement tax planners heard about the RRSP meltdown strategy the moment it became relevant to their situation. Most Canadian seniors on CPP and OAS find out about the RRIF forced withdrawal problem only when it shows up as a reduced OAS check or a larger than expected tax bill. Now you know before that happens. Now here is the part most coverage completely misses. And this one involves Service Canada, not the CRA. The OAS clawback does not just reduce your check for the current year. TFSA withdrawals are tax-free and do not affect eligibility for federal income-tested benefits such as old age security. That means every dollar you pull from a RRIF instead of a TFSA in a given year is a dollar that counts toward the clawback calculation. Over 10 years of retirement, that difference in which account you draw from first can mean tens of thousands of dollars in OAS payments that either flow to you or get clawed back by Service Canada before they ever reach your bank account. La silla rota, Gloria had no idea this part existed either. She knew her RRIF withdrawals were taxable. She did not know they were simultaneously reducing what Service Canada was sending her every month through OAS. Most seniors never find out until they compare 2 years of statements and realize the numbers do not add up. Did you know that drawing from your RRIF instead of your TFSA can reduce your OAS payments from Service Canada at the same time it raises your CRA tax bill? Drop your answer below right now. I want to know how many people watching this had no idea these two things were connected. Gloria eventually figured out what happened. She worked with a fee-only financial planner to restructure her withdrawal order, drawing more from TFSA and less from RRIF in years, where her income was close to the clawback threshold. It took 2 tax years to see the full correction. It cost her several $1,000s in OAS reductions she could not recover retroactively. If Gloria had started a partial RRSP meltdown strategy at age 65, shifting funds from her RRSP into her TFSA during the low-income window before CPP and OAS started, none of it would have been as severe. That is the entire point of this video. 3 steps you can complete this week. Step 1. Log into your CRA My Account on Canada.ca and check the current balance of every registered account you hold. RRSP, RRIF, TFSA. Note what percentage of your total retirement savings is sitting in your RRSP or RRIF compared to your TFSA. If the RRSP or RRIF holds the majority and you are between 60 and 70 years old, the meltdown window is open right now. That window closes at 71. Step 2. Use the RRIF minimum withdrawal calculator available on the CRA website to project what your mandatory withdrawals will look like each year starting at 71. Add that number to your expected CPP and OAS income. If the total approaches or exceeds $90,000, you are in clawback territory. A fee-only financial planner or a CRA-certified tax professional can show you the exact numbers for your situation at no product cost. Step 3. Share this video with one specific person in your life who is between 60 and 70, has an RRSP, and has never had a conversation about withdrawal order strategy. That person has a window right now that closes. One share from you could save them tens of thousands of dollars they do not even know they are about to lose. One more thing before we close. The CRA will never call you demanding immediate tax payment by phone. They will never ask for gift cards, wire transfers, or cryptocurrency to settle a balance. They will never threaten to freeze your accounts by text message. They will never ask for your social insurance number by email. If you receive any contact like this, hang up immediately and call the CRA directly at the number listed on Canada.ca. The real CRA sends letters. It does not call with threats. What is the one thing from this video that surprised you most? Drop your answer and your province in the comments right now. I read every single one, and if this video helped you, hit the like button right now. 1 second. It is the only way this reaches the next Canadian retiree who is sitting inside this situation right now without knowing it. Gloria's story is not unusual. It happens to Canadian retirees across every province every single year. The only difference between Gloria and someone who avoids this is knowing the withdrawal order matters before the RRIF clock forces your hand. You now know. Share this with someone you love who has an RRSP and has never heard the words RRSP meltdown strategy before they find out the hard way. I am Henry Jaden.
Take care of yourself.